Okay, let's talk about AI. The market has been on an absolute unstoppable tear. But you have to wonder, after a run this historic, could a major shakeout be just around the corner? We're going to dig in and see what history has to say about all this.
I mean, just look at these numbers. The market has just pulled off one of the strongest three-year runs ever. We saw 24% gain in 2023, another 23% in 2024, and this year we're already up 16%. Those are just staggering returns, and right now it feels like nothing can stop this train.
But, and this is a big but, when you zoom out and look at the bigger picture, historical patterns, well, they start to paint a very, very different picture. And this isn't some small warning sign. The data is crystal clear on this one. Every single time we've seen this exact kind of three-year surge, that fourth year has almost always ended in the red. That's a heck of a historical precedent. And if that wasn't enough to make you pause, we're adding another layer of risk into the mix. You see, 2026 is a midterm election year in the US, and that particular timing has its own pretty distinct market history. So how bad are we talking? Well, what's so fascinating here is that we can actually put a number on that risk. Historically, that midterm year is the absolute worst performing year of the four-year cycle. On average, the S&P 500 sees a correction of about 18%. Of course, patterns and cycles are one thing, right? But they don't just crash markets out of thin air. You need a trigger, a real-world catalyst to actually spark a downturn. So the billion-dollar question is, what could that catalyst possibly be?
Well, the potential catalyst might just be a single name that you know very, very well. A company that's sitting at the absolute epicenter of this whole AI boom, OpenAI.
And the potential problem really boils down to this, just staggering number. OpenAI is reportedly on the hook for over $250 billion in compute commitments to power its models. That's $250 billion. So what's the deal with this $250 billion problem? Well, for starters, these are huge commitments to giants like Microsoft, Nvidia, and Amazon. And a recent study is suggesting that even with super aggressive revenue goals, OpenAI might not be able to pay for it all. Throw in some fierce competition from rivals like Google Gemini, and the fact that it all depends on private investors who could get nervous, and you've got a recipe for a potential cash crunch. Now, let's be really, really clear about something. This is not an argument that AI is going to fail. Not at all. It's simply an argument against the idea that any revolutionary market, no matter how incredible, can just go straight up forever. That's just not how things work. And this brings us to a really important concept in tech cycles. It's called a shakeout. Think of it like a sort of market spring cleaning. It's a natural phase where weaker or overextended companies get cleared out, which then allows the stronger players to consolidate and really lead the next wave of growth. Or to put it a little more bluntly, as one source does, every major tech revolution has a brutal shakeout phase that cleans the garbage. You see, it's not viewed as a failure of the tech, but as a painful and maybe even necessary step in its evolution. So with this potential for a shakeout on the horizon, how do you prepare? Well, the analysis really breaks it down into two different mindsets. You've got the all-in risk approach, fully invested but totally vulnerable with no cash if there's a dip. And then you've got the defensive liquidity mindset, which stays in the game but builds in some serious protections. So what does a defensive strategy actually look like in practice? Well, it breaks down into four pretty simple steps. First, you stay mostly invested. You don't want to miss the upside. Second, you hedge a bit with some defensive non-tech positions. Third, you keep some cash ready and on the sidelines. And fourth, you get ready to use that cash to buy the dips if a correction does happen. You know, there's a fantastic analogy for this whole strategy. It's like carrying a parachute and extra supplies while climbing a very high mountain. The key is, you haven't stopped climbing, you're still invested and going for the summit, but you're prepared just in case things get a little treacherous. Here's another great way to think about it. Imagine the market is a marathon runner who's been setting a record pace. The historical headwinds and that potential catalyst, well, that's a steep, rocky patch up ahead. Having that cash and those defensive assets is like having enough energy left in the tank to power through it, while other runners start to fade. Which leaves all of us with one final big question to think about. Is the AI boom facing its own steep and rocky climb? And if it is, have you packed your parachute?